I feel like there's so much going on in the world these days. It's almost like whack-a-mole, right? When you're, whacking one thing down, something else pops up. At one point, it was like COVID, and then of course after that, it was the supply chain issues. And of course, right now we're focused on what's happening in the Middle East.
Lately, it feels like the news cycle is moving so fast, it's really hard to keep up, but we know these shifts matter and that they have real implications for our portfolios. So today, I'm joined by Jennifer Lee, Senior Economist and Managing Director at BMO Capital Markets, to cut through the noise. She's going to share her perspective on what's really happening across global economies and the key risks that investors should be keeping an eye on. Before we do get started, a quick reminder that we're not providing any investment advice or recommendations. As always, today is about information and education. Jennifer, thank you for joining me again. It's been far too long.
Thank you. Pleasure to be here.
As I mentioned, Jennifer is a senior economist here at BMO for nearly 3 decades. I don't even know how that's possible, Jennifer. I need the skincare routine. Drop the skincare routine in the comments below.
Let me be honest here. It's actually been 30 years. I just passed the 30-year mark.
30, congratulations.
Right out of kindergarten. Right out of kindergarten. Thank you.
It's great to have you back on. I want to just dive right in because we've got a lot to cover. Maybe we zoom out for a second and look at the bigger macro picture. I want to know, what's something that you think investors aren't paying enough attention to right now?
Well, again, thank you very much for having me on today. I feel like there's so much going on in the world these days. It's almost like whack-a-mole, right? When you're, whacking one thing down, something else pops up. At one point it was like COVID, and then of course after that it was the supply chain issues. And of course, right now we're focused on what's happening in the Middle East, the war in Iran, and of course the closure or the near closure of the Strait of Hormuz. And this is what we are focusing on right now. This is the latest mole that has been popping up. But there are all these other issues going on around the world, like geopolitical shifts, where other countries are trying to take control or secure more control of, for example, satellites. There's spots in space for satellites for intelligence gathering. There's a lot more efforts to secure spots, in for oil and gas pipelines, for shipping waterways, such as the Strait of Hormuz. There are a lot more countries now that are trying to secure a lot more water because nowadays, especially with AI, there's a lot more demand for water. And it also doesn't help with, with climate change and all that, and water levels are actually declining. So that is also a supply issue as well. So all these things are going on. There's like deep sea mining. That's another one where countries are trying to, again, mine underground, underwater for things like critical minerals, like gold and silver, copper, all those sorts of wonderful things. So these are things I feel like we are not always focusing on because, again, it's not the latest mole that has been popping up. So right now it's all about the Strait of Hormuz, and it's interesting because it's like we've come to this sudden realization that, oh, maybe we shouldn't have been so reliant on this one particular chokehold point, I guess, for all these shipping lanes, or to get oil out there or to get fertilizer out there. But this is something that is not new. We've had different types of political problems that have stopped shipping in places like the Red Sea or the Black Sea. We've had climate issues, again, lowering water levels in places like the Panama Canal,
Right.
or the Rhine River. Do you remember that? Human error. Do you guys remember the was it the Ever Given, that
Yes.
Suez Canal, where the guy made, he basically made a bad turn, was trying to make a 3-point turn out of the canal, and was stuck there for a couple of weeks. So all these things have happened. So these are all things that we tend to forget about, but at the same time we should not completely ignore, because this is not completely at our attention right now. So I feel like there are a lot of things out there that do require our attention.
Yeah, that was a long list, with the Strait of Hormuz being the most obvious whack-a-mole. But yeah, it's definitely a lot more ready to come up and bite us here. Let's talk about rates. There's been a lot of debate around timing and pace of rate cuts. What are the key signals that you're watching most closely to shape your outlook, and what is your outlook on that front?
Okay, so because you mentioned rate cuts, I'm just going to assume that you're talking about the Federal Reserve, because everyone else out there, from what I remember, they're not cutting rates at all. So, for example, we've got the Bank of Japan was first out of the gate. They've raised rates about 4 times so far, and they're not finished yet. The RBA has gone about 3 times. They're probably going to pause. Norway has gone once. New Zealand is about to go probably sometime this summer. Bank of Canada is, as you know, we expect them to be fully on hold at least until we'll see what happens with the USMCA talks. So, that basically leaves us with the Federal Reserve. So, up front, we are still looking for a couple of rate cuts, but we've been pushing out our call for when that's going to happen. We're looking for probably rate cuts coming in December and one more in March, 25 basis points each. And then that will be it. But we, again, truth be told, we've been sort of pushing out our rate call or rate cut call just because even before what happened with Iran, there have been signs of stickier inflation. The data have not really supported the data have not given us a strong support, I guess, for a rate cut because overall the U.S. economy has been holding up. We're still seeing resilience out there in terms of business investment. From all things AI, the consumer. We should never ever underestimate the U.S. consumer, although he or she seems to be a little bit more cautious these days, just given all the price hikes that we're seeing out there in terms of groceries and energy. But overall, we are going to take this. I'm going to quote ECB President Lagarde. I think she was the one who coined this first. We're going to take everything on a meeting by meeting basis, and everything will be data dependent. But right now, we are still looking for Fed rate cuts just later on in the year into early next year. But I will say this: I do not envy Fed Chair Warsh at all. I have to get used to saying Fed Chair Warsh. I mean, he's got a very tough job ahead of him, especially if he's still calling for rate cuts, because it's going to be very difficult to convince a majority of those on the Federal Open Market Committee to also support a call for a rate cut, not in this environment.
You mentioned sticky inflation, so let's turn there. What are you seeing right now, and how do we think about that, where we're headed from here?
So I'm going to say this: it depends on who you're talking to about inflation. In our group, I've been a bit more on the hawkish front when it comes to inflation. But one thing's for sure: there is no such thing as groupthink in the BMO economics. Everyone has their own opinions. But I think even before what we've seen in the Middle East, I was a bit more concerned about inflation. We saw sticky inflation because of just last year all the different immigration policies, deporting undocumented workers. And these are workers that are great demand in the U.S. agriculture sector. About 50% of those workers were all undocumented. The construction sector, 20% of all workers there were undocumented. Leisure and hospitality, about 12% of all workers there were undocumented. So that put some upward pressure on supplies of things, on the supply chain of things, and of course on the wage front. Demographics in general also put some pressure on wages, especially when you have the aging of the baby boomers. Back a couple years ago, there were about 4.1 million Americans that turned that magic age of 65. They called it the silver tsunami. They called it peak 65. So we're seeing that not just in the US, but it's around the world as well. Of course, the trade and tariff policies certainly had an inflationary impact, maybe not as much as what many of us or myself had expected, but it certainly put upward pressure on things like food, for example. When you have 60%, I think, of all fruit that is consumed in the U.S. is imported. About 35% or 40% of all vegetables that are consumed in the U.S. are all imported. And roughly 85% of all seafood that's consumed in the U.S. is also imported. So that, of course, you're going to see some upward pressure there. So not a shock to see some of the pauses and some deals that the administration has put through just to ease some of the pressure. Climate change, of course, causing some wonky patterns in planting plans around the world. We've had record high prices of olive oil in Spain, for example. Rice prices in Japan surged like 100%. Beef prices, because of drought in the U.S., we've got a much smaller herd of cattle, for example. So, of course, and then there's AI demand. That's another thing we should mention. A lot more upward pressure on electricity and water. So all that makes me very, very nervous.
Might be making you nervous, but it seems like the consumer is just chugging along and staying quite resilient. What's keeping them going, and where do you see the biggest risks to that strength?
So I think overall over the last couple of years, it has been a bit of a surprise, that they are, continuing to forge ahead. But I think, stock markets have definitely played a big role in keeping consumer spending habits, stronger, or at least enabled them to spend. The job market has been still fairly resilient despite everything that we've read about. We still have, especially in the U.S., a 4.3% jobless rate, which is still fairly low, and wages continue to rise, and that sort of helps as well. Affordability has actually been acting as a constraint. But then again, we've started seeing some pauses and some deals made from the Trump administration and some of these tariff policies that they've created. So that has helped a little bit as well. But I am starting to get a little worried. Just if we continue to see upward pressure on energy prices, whatever you're paying at the pump, if you're still seeing upward pressure on food prices, whatever you're paying at the grocery store, that is certainly going to start creating some more cautionary feelings, I think, from the U.S. consumer and Canadian consumer as well.
For sure. And let's talk about the labor market, always an important indicator. What's happening in employment data, and what should investors be thinking about here?
So overall, and again, this is going to vary on a country by country basis, but overall, I think that labor demand has been softening, just because we're seeing growth around most of the world, starting to slow, some at a little bit of a faster pace than others. But at the same time, it's not just demand, right? It's also supply. So even though the demand for workers has eased, we've got a smaller supply of workers out there as well for all those reasons I just mentioned before, like the immigration policies and of course, we're not exactly adding organically to the pool of workers. We've got birth rates basically at record lows, depending on what country you're talking about, but for much of the OECD, very, very low birth rates or fertility rates. So that's not helping. But overall, again, still fairly resilient. There's some questions about whether or not AI is taking away from labor demand, and that's still a big question out there. And interesting, just earlier today, we had this much stronger than expected report on job openings from the U.S., and it showed the number of job openings up at the highest level in about 2 years. But overall, I would say that for investors, you got to be cautious when you see these numbers, whether they're good or bad. Take everything with a grain of salt, especially the job reports, like the headline job reports, because the response rates are a lot lower than they used to be. They used to be like 90% response rates. So you can kind of count on these numbers to be pretty accurate. Now they're dropping around to about 60% over the last few years, ever since COVID. So you have to take everything with a grain of salt. Look at all of the economic job data, or all of the economic reports out there that have job reports in them, and make sure that they're all telling the consistent story. Don't ever look at just one report um, independently, because again, you want some accuracy, so you got to look at all of them.
We know global events matter, but how should Canadian investors think about sort of their real impact, especially when it comes to things like China's growth or all the geopolitical tensions that we're seeing? What does that mean for Canadians?
Well, everyone should be totally paying attention. We can't say, it's not, it's so far across on the other side of the world. It doesn't impact us, but it totally does. And we're seeing that right now, like for the Strait of Hormuz, on the other side of the planet, but at the same time impacting every single person around the world. So we cannot live in a vacuum, right? Especially here in Canada, where we are so reliant on trade. Um, you know, uh, Besides housing, we were also big on manufacturing, oil and gas, and also trade. And this is another reason why Prime Minister Carney has been basically going around the world, sort of, pushing Canada as a reliable trading partner. And we have a lot of stuff, right? We have a lot of things that the world needs right now. All those critical minerals, potash, oil and gas for sure, liquid natural gas, LNG. In fact, we just signed a deal with Germany very recently for Germany to buy a lot of our LNG. So that's great news. So these are things that, again, we do not live in a vacuum. We still need to be doing a lot more trade with other countries. So we do need to care about what's going on over the rest of the world.
In our mic check before we got started today, we were having some mic troubles and you were making me say the word recession. So let's end off there. We've been talking about a potential recession for a while now. So what's the latest from your perspective?
Oh, so interesting. You mentioned the word recession. So just very recently, just last week, we finally got the latest quarterly numbers for GDP for Canada. And it was a bit of a shock heard around the world that there was a negative sign in front of it. It was small. It was a 0.1% annualized contraction, but still, it was very surprising because the monthly data were certainly not pointing in that direction. And on top of that, that was for Q1. And on top of that, that follows a quarterly decline in the fourth quarter as well, downwardly revised, a little bit worse than expected, a 1% contraction. So, everyone's like, oh my gosh, that's two consecutive quarters of negative GDP growth. So the word recession started making the rounds. But, I will say this, hold up. It's, even though by definition or whatever, you're thinking that it is a recession, but it doesn't completely meet the official definition. First of all, there's another group that will make that call, and they'll make it in like a number of months' time. But it doesn't meet the 3Ds. It was about depth, dispersion, and duration. Our Robert Kavsick actually wrote a great piece about this in our weekly last week about depth, duration, and duration. And so far, the depth has not been very deep. It's only been a couple of quarters, but I think we need another quarter of, and it's going to be a big decline, another contraction for us to actually think that this is a recession. At the same time, we also have to worry about what, by the way, it wasn't dispersed as all. It wasn't spread across the entire country. A lot of that decline in Q1 GDP was because of exports. It was because of business investment. And those are the two things that are really impacted by all the USMCA talks right now. People are very nervous. Businesses are very nervous. And we're seeing our trade contract, obviously, considerably in the first quarter. But at the same time, government spending, that was another place, an area that contracted as well. Another surprise. But the consumer that drives basically the economy, like over 2/3 of economic growth is driven by the Canadian consumer, still up a strong 1.5%. So that, to me, is not a recession. Sure, the headline, can't ignore it. 2 consecutive quarters of negative GDP growth. Not great news. At the same time, look beneath the surface. The details weren't as weak. Just like what I was talking about with the job numbers. Yes, you got the headline, but you got to look at all the different numbers out there to make sure we've got the right story. And for what we've seen so far for the Canadian economy, things are slowing. Certainly, no debate about that. But at the same time, it is not a recession.
Okay, depth, duration, dispersion. That's my new mantra. I love it. Okay, thank you so much, Jennifer, for joining us today and providing all your insights on the economy. Appreciate it.
Thank you.
That's all for today. Thanks to our viewers for tuning in, and we'll see you next week. Bye for now.